Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. We have a lot to unpack here this morning. I hope some of you were able to join us last night where we discussed how to prepare your portfolio for a recession, because a lot of the things that we talked about last night, we're going to also extend into the session here today. We're actually going to talk a lot about the different themes that we're currently looking at. So let's go ahead and get started. Now, before I do, just a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first start off by talking about the overall market. This is something we've discussed for many weeks now. We've declined about 35% and rallied about 60% of that back, if you will, back to the 20-week moving average. We've been stuck at this 20-week moving average between this 280 and 290 range for quite some time. Looks like we're about to open up slightly above that 290 range. Right now it's at about 291. This is something we discussed quite a bit last night for those of you that joined us during our session, where we talked about we're currently in this state of a bit of an equilibrium, and it kind of reminds us a little bit of the rally that we had from November to February of 2020, where markets just kept on grinding higher, valuations kept going higher, despite the fact that corporate profits were not growing. And right now, this certainly is a very different scenario than what we had back in January and February, where at least corporate profits were stable, economic outlook was relatively strong. Right now, we have the opposite picture, where economic outlook is extremely weak. We are now technically in a recession, and corporate profits are declining, yet markets continue to grind higher. So many people are asking, how is this happening? Why is it happening? And those are some of the things we're going to discuss. I will say that from looking at a chart perspective, we're not concerned so much as far as why, but what is actually happening. So that's what we're currently seeing in the S&P 500. This is what we've discussed for quite a few weeks. This 20-week moving average on the weekly chart is certainly going to act as pretty large resistance, and it has for the last few weeks, but the daily chart continues to grind higher, despite certain signs of exhaustion here in the markets that we've seen. So every time the market has continued to push higher, notice how momentum does not continue to move higher. It continues to actually move lower, which is the same sort of decline in momentum that we saw back here in January and February. Every time the market pushed higher, momentum kept going lower. Now, one of the things that we discussed last night during our session, our educational session, was the fact that just because you see negative divergence, just because you see momentum slowing down, just because you see money flow being weak, does not mean that the markets are going to move lower. That just means that markets can continue to be in this state for significantly longer amounts of time. It could be a week, it could be a month, it could be 3 months. It's really difficult for us to tell. And what the catalyst that actually triggers the next sell-off is unknown. Just like how we could not have possibly predicted COVID-19, what's going to cause the next sell-off? Perhaps another second wave of coronavirus cases because we reopened some economies too early. It's really hard to tell, but it's really important that we know that this is happening, meaning we understand there's a higher risk of a pullback, and we position ourselves correctly for that, which predominantly means selling premium right now, collecting premium when things are in this relative calm, and then utilize that premium when you do need it to buy some puts to protect your portfolio if there is that sell-off, or when that sell-off comes, rather. So some of the things that I really want to discuss here today is really just this bifurcation that we're starting to see in this market. So while we kind of see the S&P 500 remain relatively flat, there's still a lot of movement from underlying stocks, and we could even see it from the broader indices. So if we look at the Russell 2000, the Russell 2000 has remained incredibly weak compared to the S&P 500, having not even reclaimed 50% of the initial sell-off. It made one small move to the 20-week moving average, but got rejected very quickly. It started to show a little bit of strength here earlier in the week or late last week, but that rally has really kind of fizzled out and looks like it's trying to make another move to the upside right now. Some of the levels we're really keeping an eye out here is around 136 or so, which formed a bit of a double top here. You have a 142 gap that is still left to be filled. So you have some resistance up here in the 136, 142 zone. That is likely going to act as a pretty big resistance here for small caps. So small caps clearly not joining in on this particular rally. And on the flip side, you have technology that looks extremely strong. Now, today what we're going to talk about are some of the post-COVID-19 trends that we currently are looking at. How do you think about investing in the long term beyond what we're currently going through as things get back to normal? What are we looking at? So these are some of the things we're going to look at here today. I actually have a lot of charts to share with you. But technology, much stronger, rallying almost 80% of the initial sell-off. It's above its 20-week moving average. The daily chart, similar type chart to the S&P 500, same type of exhaustion, because every single time the market continues to move higher, momentum does not continue to move any higher. Money flow remains very weak on the weekly charts, and they certainly are overbought by most indicators on the weekly charts. The daily charts, again, just showing those signs of exhaustion, which again, for this type of environment, what you generally want to do is when they reach this type of top, you want to sell a call credit spread. When they reach a bottom, you sell a put credit spread. And this is really the only way to trade this type of market. And if and when you get this initial sell-off, what you hope to have done is at this point, you would have sold some premium, sold cover calls on stocks that you own, sell credit spreads on stocks that you have a directional view on, so that you collect some premium, and that when that market breaks lower, that's when you want to buy some puts. And just last night during our education event, we discussed what indicators do you want to utilize to determine when do you buy that put, when do you see that acceleration to the downside. So, and we look at some of those things here every single Tuesday and Friday morning. So for those of you that missed that, I highly recommend you to go back and watch that, because the two, I think, are very useful in conjunction with each other. So some of the things I want to discuss here today is markets continue to grind higher. That's the new reality. And there are clear signs of exhaustion as every single subsequent rally that we have, but we have no signs of a reversal yet. So this is a bit of a deja vu. And again, pointing back to the January, February range of last year, when the markets were rallying after January 1st, made a pretty strong rally, and we were talking about a pullback maybe in February. We got to look at that in early February, but it continued to move a little bit higher before it sold off. And every subsequent rally, we saw momentum start to move lower. And that's exactly what we're seeing now. But one thing to keep in mind is that this type of exhaustion, this type of momentum not confirming these highs, that can go on for a while. So that in itself does not mean markets are going to correct. So I want to make sure that everyone's clear on that. In this particular state, you're better off selling premium and then waiting for that actual risk off indicator. So one of the things that we look at is VIX. We talked about this on our session last night, where when the front month VIX accelerates above the 3-month VIX, that's our first risk off indicator. That triggered on February 21st, which is just 2 days from the peak of that February 19 peak. So this is a pretty good and fast, reliable indicator to give us a risk off indicator. And that is not triggering right now. We're still in this risk on environment. Front month VIX is trading at 29. 3-month VIX is trading at 34. Front month VIX is clearly below the 3-month VIX. So we're in this risk on environment. If we look at other things that destabilize things as we had that panic sell-off, oil and high yield also remaining fairly stable at this point. Oil has stayed around that 21, 22 level for quite a few days. That's the WTI front month contract. High yield, HYG, also has been trading in a very stable range for the last few weeks. If we see a breakout or a breakdown, that's when we might have some indication of things going south. But until that happens, certainly right now things are fairly stable. Liquidity has actually decreased a little. So the last few weeks we were talking about 180, 200 very liquid option symbols. Yesterday, this contracted, or actually earlier this week, and contracted back to 153. So liquidity is coming out a little bit from the markets. Maybe this is some of the signs that we're looking for, but however, things, again, have not triggered any type of risk-off sell-off just yet, but liquidity certainly evaporating a little, as we discussed. About 180 to 200 last week is now down to 150. So I have a lot of charts to unpack with you today, but the main theme really is looking at the COVID-19 trends. I want to readdress some of the COVID-19 trends because there have been some changes, and I think some that are worthwhile to look at. And it really speaks to the bifurcation that we see not only in this country, but also globally. And I want to talk a little bit about what bifurcations we see, because as I showed you, between the small caps versus technology, we have this huge bifurcation between the haves and have-nots, and we're seeing that across sectors, we're seeing that across industries, and this is the type of theme that you should be thinking about as you consider, how should I invest post-COVID-19? And this is thinking a little longer term. This is not just thinking about what's going to happen in the next week or next month. This is thinking about what's going to happen in the next year, perhaps even the next few years, and even thinking about longer term, like the next decade. So we want to talk about what are some of the winners and losers that come out of COVID-19, some of the bifurcation we're seeing in the market. So we have a lot of charts to share with you here today. Now, we're going to start off with the COVID-19. So we covered this heavily in the first few weeks during the initial sell-off, and then as kind of markets dislocated from all of this type of data, dislocated from economic data, we stopped looking at that because it simply provided I think a false view of where markets were going to head in. But I do think that this particular chart that I'm currently looking at speaks to some of the trends that we're seeing in the markets, which is a bifurcation. So right now we have about 21 states that are still continuing to see increases in cases for COVID-19. And many of these states are the states that are actually reopening their economy. And I think this really adds to the potential risk of a second wave or an increase in cases, as many of these states may continue to experience. I don't know if this will stay contained, like perhaps like in Sweden, where despite that a state opening their economy, and I certainly understand why they want to open it, right? Because their states have suffered severe economic depressions, and they want to help their citizens, get back to work. And if you look at states like Sweden that didn't close down, where people simply just did whatever they wanted to social distance, and people were able to go back to work, they still saw about a 70% decline in economic activity, and they certainly saw about tenfold in terms of number of deaths compared to their neighboring countries that locked down. But they managed to reopen, and they didn't see a huge acceleration in cases compared to their, or at least many of those neighboring countries are back to reopening their economy, but there isn't a huge difference in terms of the number of cases. So that might be a reason why reopening these states might be a good idea. Again, it's too early to tell. We have only 13 states where the number of cases are decreasing, and then 11 states where the cases right now are fairly stable. So right now, this is a trend that we're going to watch and see whether this is going to increase or decrease. Like I said, we have 21 that are increasing, 13 that are decreasing, and then 11 that are fairly stable. So we really want to watch this trend and see if this continues to accelerate, because New York is clearly on the decline. This is really the bulk of the cases here in the United States. There's clearly research that shows that the bulk of a lot of these cases in these other states came from New York. There are predominantly two places that it came from, which is Washington and New York. And Washington is, trying to find Washington here on this chart. Washington is up here. So most of the cases that we saw, the research is that it came from predominantly two places, New York and Washington. So the fact that we didn't have a federal response to the to this, and we didn't lock down states and stop travel from the hotspots, which predominantly were Washington and New York, that's really what caused a lot of other states to contract this. So those are some of the trends that we're looking at. And if we look at reopening, so last week, this week, a lot of states started easing some of the restrictions. I don't think we would call this a full-on reopening, but giving citizens the option to decide whether they want to go back to a restaurant or go back to a shopping mall and reopening some non-essential businesses. So some of the trends is that we see small uptick in things like restaurant bookings. As you can see, a small uptick in number of workers that are going back to work. But as you can see, this uptick right now is still very small, so, and very early days. So right now, I think a lot of the question is, even if economy opens, are citizens going to be comfortable enough to get out there and get back to work and go shopping and do the things like going back to a movie theater? The answer seems to be, at least in the early days, that most citizens, despite the fact that their economies are open, do not yet feel comfortable enough to go back to work and go out to restaurants. But let's see how this data pulls out over the next few weeks. So some of the things I really want to talk about is really this new bifurcation and what the new world of post-COVID-19 is really going to look like. And what I'm going to do is I'm going to show you a series of charts where we're starting to see this bifurcation of haves and have-nots. And this is really how you should think about investing post-COVID-19, meaning what type of companies are beneficiaries as a result of this, and what industries or what companies may be challenged as a result of COVID-19. So first and foremost, one of the strongest trends that we see, and this is something we've discussed over the last few weeks looking at Bank of America credit card data, is really the difference between physical stores and online or e-commerce. E-commerce is seeing almost 100% gain in spending because you've seen about a full contraction of 60 to 70% in physical stores. And that's obviously expected. So then you think about, we've been talking about the payment space for months before the COVID-19. We talked about names like Fiserv, Global Payments, PayPal. These are all names that we've been talking about. Visa and MasterCard were very strong stocks going into COVID-19. But as you can see, as a result of COVID-19, this is a new world. Online payments, PayPal, which has almost 100% exposure to e-commerce versus physical stores, is a clear winner here versus a stock like Amex. Amex is a Dow 30 stock. This is one of the largest stocks in the US economy, taking a huge hit and not recovering at all, versus e-commerce is really the new trend that we're going to emerge out of COVID-19. And I think this is going to last for a lot longer than we anticipate. Many of the research that we looked at when we first started doing these market outlook sessions 4 or 5 weeks ago, we were looking at Q3 getting back to normal. That doesn't look like that's going to happen. I don't think we're going to look at Q1 before people really feel comfortable leaving their house and getting back to public transport and getting back on a plane, perhaps even longer. And the longer that goes on, the bigger this bifurcation you're going to see in, for example, the payment or the retail space between e-commerce versus physical stores. Digital strategies also is something that is going to be a big winner versus loser in this particular space. So whenever you think about companies in an industry, companies that have invested in a digital strategy versus companies that have not are going to be winners versus losers. So McDonald's, clearly a decliner here versus Domino's Pizza. Domino's Pizza, we've been talking about for years, is really more of a tech company than a pizza company. They just simply monetize their tech through pizza. And we expect this type of trend to continue going on. So any of these restaurants that rely heavily on physical stores and do not have a digital strategy, I believe is going to continue to be in a challenged environment. And then you look at companies like Chipotle and Domino's Pizza that have invested heavily in a digital strategy will likely see gains here in post-COVID-19. Same thing in some of the retail stores. We've talked about this stock on Options Action many times as well, Dollar General. Dollar General is the discount store, which generally speaking will do well. This is our daily play for today. Discount stores generally do well going into a recession, but both Dollar General and Dollar Tree operate in the same space, but Dollar General has spent a lot of efforts in digitizing their strategy, ordering online or on the app and picking up in the store, self-checkout, versus Dollar Tree has not invested in any of that. And you're seeing this clear bifurcation in two stocks that were for a long time fairly heavily correlated to each other. Old versus new telecom. This is something that we are also seeing. You can clearly see this throughout most of the stocks that we call streaming stocks, whether it's Netflix, Disney. Well, Netflix, I think a better example, because Disney has a lot of physical components to it. It also has a lot of the old telecom components to it, namely cable TV, Disney Plus being relatively small revenue, small percentage of their revenue, so not a gainer like Netflix. But if you think about Netflix, you think about Activision, the stocks that are doing well as we stay at home. And the companies that have invested in this new telecom, like T-Mobile's predominantly investing heavily in 5G versus the old telecom model of AT&T with a lot of still, think about cable companies that they own, all the media companies they own, and all the cord cutting that's currently going on. You have these bloated media companies, conglomerates like AT&T, Verizon, that will continue to be in a very challenged environment in this COVID-19 world versus stocks like T-Mobile, Netflix, Activision, these types of stocks that will do well as we continue to be locked down and perhaps work from home significantly longer than we had originally anticipated, which I think many people thought was just going to be a few weeks, maybe a month or two tops. I think that reality is going to be closer to maybe 6 months before many people to be working from home. And maybe you might say that that's a little too long, but I certainly think that risk right now is skewed more to the longer end than that we really just get back to normal in the next few weeks. Industrials is also something that's very, one of the trends that we think is going to emerge out of COVID-19 is really ESG. And ESG investing is something we have heard about for quite a few years, but I think post-COVID-19 is just simply going to accelerate our needs for environmental and social governance on the, especially industrial stocks. So you look at companies like Tesla that are thinking about cleaner tech. And we really don't think of Tesla so much as a car company as we do as a battery company. So especially investments in solar, investments in wind, investments in battery technology, those are the companies that are likely going to see gains or beneficiaries as a result of COVID-19, because we think that there's going to be an acceleration towards environmental and social causes versus traditional automobile like GM, Ford. These are industries that are going to remain very challenged in a post-COVID-19. We're likely going to see less driving because more people are going to work from home, more meetings are going to happen remotely, and that's going to be a challenge for companies like General Motors. And we're not thinking about Tesla as a car company. We're really thinking about Tesla as a larger environmental play here. Staples is also an interesting sector, because we generally see staples as a net beneficiary of this particular environment, because right now we're likely going to be staying at home longer. We're going to be buying more of our staples because we're less likely going to be going out. And really the only sector that we see that is going to be a net, that's going to be very challenged as a result of all of this, is really tobacco. Perhaps some cannabis companies as well, but tobacco certainly is going to be a company, is certainly going to be an industry that we think is going to remain fairly challenged after COVID-19, with the obvious respiratory issues with smoking that causes some of the concerns with COVID-19. Healthcare is also a space that, as a whole, generally speaking, has held up very well. It's a space that I would say, generally speaking, is not as sensitive to economic recessions and declines. However, there is a clear bifurcation right now in healthcare with respect to physical versus telemedicine, or meta tech, if you will. So this is a stock that I've talked about on Options Action. We went long on this particular stock, Teladoc. I actually expect this to continue, because some of the data that I was looking at to go long Teladoc was looking at basically a Q3 resumption of going back to normal for this particular. So seeing a slight bump in Q1, bump in Q2, and then going back to normal in Q3. I actually think that this is likely going to extend well into Q3 and Q4. So I see that there's potential gains for stocks like this, and any type of stock that's invested in a digitized strategy for medicine is going to be a net beneficiary versus traditional hospitals like UHS, is really going to remain fairly challenged here. If we look at some of the financials for a lot of the healthcare providers, they are fairly strained. They are cutting costs across the board. And it's a challenged environment for them. So these are the types of bifurcations we're currently seeing in the healthcare space. But I will say, biotech, pharma, those are still very strong sub-industries, if you will, within the healthcare space. Aerospace is also one that we think is going to be very challenged in a post-COVID-19 world, with the exception of defense. We think defense in a new world post-COVID-19 is going to become more and more of governments are going to spend more and more on defense as we continue this. I don't want to call it a trade war. I think it's beyond just a trade war now. I think right now many countries are blaming each other for the result of COVID-19, and I think that's going to put walls up. I think globalization is going to become, there's going to be more of localization, less globalization, which is going to increase defense spending. So you have a clear bifurcation between companies that benefit from globalization, such as airlines like United, American, Delta, versus defense contracts such as Lockheed Martin, Northrop Grumman, General Dynamics, these types of companies that provide aerospace parts to the defense industry. So those are some of the trends that we currently see in aerospace. Miners versus chemicals. Chemicals, I think, as an ESG investment, is going to remain fairly challenged here as well. We see this across the board, across most of the major chemical providers here, versus miners. Miners, we're talking about gold, especially gold miners, are really doing quite well here, and we think that this is going to be a bit of a bifurcation we're seeing within the materials space. Semiconductors across the board is very, very strong. We do see some weaker semiconductors, such as Texas Instruments, which we're currently short. But if we look across the board, any of the major semiconductor stocks, these are ones that are doing quite well in this particular environment, and we expect that to continue in this particular environment. We think that as online electronics, which we saw from Bank of America credit card data, online electronics is one of the few categories that remain strong throughout the entire COVID-19, unlike retail, which at first took a dip and is now recovering, e-commerce that took a dip and recovered. Online electronics remain strong. We think will continue to be strong, especially as there is a shift to more people working from home and buying electronics that they need to be able to work remotely. Security companies that are going to need to help secure work lines and things like that. So those are all companies that we think are net beneficiaries as a result of COVID-19. Gen Z, this is something that's also we're seeing a clear acceleration towards a new generation of consumers. Think about Snapchat, think about Activision Blizzard. When we look at Google search trends, we're actually seeing significantly higher search results from what traditionally are Gen Z topics versus your older generation of baby boomers. And we're seeing this acceleration of shift for companies that service the Gen Z. So think about Snapchat, think about the gaming stocks like Activision Blizzard that have remained extremely strong throughout all of 2019 and has only accelerated as a result of COVID-19. Snapchat, also a stock that we usually don't think about very much, but it has remained extremely strong throughout 2019, starting at about $5, now trading at $18. You know, we don't think much of Snapchat because it's something that many of us don't utilize in our day-to-day, but these are the trends that are emerging from this new generation of users, and they are a huge mover of e-commerce right now. So pay attention to these types of trends, because we're seeing significant gains in these industries compared to the S&P 500 and more traditional forms of media and telecom. Working from home is going to be a very strong trend. Stocks like Team or Slack, very strong gains from 2019 till now, more than 100% gain. Same thing with Microsoft, going from 100 to 183, 80% gain over the last year. And this is across the board. Small names, I think you're going to see some pretty interesting stocks in this particular space. We have quite a few on our watch list, but even the major large cap stocks like Microsoft are going to be huge beneficiaries of this type of trend of working from home. But there are plenty of smaller technology companies that are emerging as a result of this, that you're going to see some significant gains as a result of this. So I think that's the last chart. Yep, that's the last chart that I have to share with you. I know I unpacked a lot of things and I showed a lot of charts and I went through them very quickly because I simply had so many charts I wanted to share with you. But these are the trends that we're seeing that across the board are creating bifurcations in the market. So what you're going to see is this new world of haves and have-nots emerge out of COVID-19. And even though the markets are fairly stable, or let's not say stable, the markets are fairly sideways, we're seeing a lot of movement in particular sectors and industries, and we're seeing this across the board, all sectors, this bifurcation that's currently happening. So today was just meant to give you a sense for the type of bifurcation we're seeing, the trends and the themes that we're seeing in terms of bifurcation, because no matter where you look, no matter what sectors you're paying attention to, they exist. You just have to look for it and know which industries are likely going to be a net beneficiary and which ones are going to be that's going to be fairly challenged as a result of COVID-19. So I hope that this was useful in helping you guys set up your day. Looks like the markets are about to open slightly higher here at about 290, but we're still kind of just in this battleground between 280, 290 being the upper end, 280 being the lower end. The markets are really kind of in this sideways range. And for those of you that are trying to position for this particular market, please make sure that you go back and watch our recording from last night on how to position your portfolio for recession, talking about selling premium right now, selling cover call, selling credit spreads, collecting premium, because the exhaustion that we're currently seeing will likely result in some form of a sell-off. As far as when that sell-off happens, I don't know, but when it does, you're going to need some premium to buy some puts. So you want to collect that premium now. So please go ahead and watch that recording if you have not already done so. So with that, I want to thank everyone for taking the time out here this morning. I just want to leave everyone here with a quick note, to allow us to continue to do this. I really hope that you guys consider supporting us. We're doing this every single Tuesday and Friday morning to keep you updated as far as where the markets are, what research we're looking at, and this is all supported by you guys becoming members. So I really hope that you guys can consider supporting us. I'll send the link to everyone here in the chat window, and I hope you guys have a great Friday. This session is recorded. We'll be sending out the recording to everyone here in a few minutes so that you can watch this. We'll also send you a recording from last night's session about the how to prepare your portfolio for a recession, because again, I think this particular session and last night's session go really well together and helping you position for this particular market that we're in. So thank you so much. I hope you have a great Friday, and I'll see many of you on CNBC later tonight. Have a great day.